Welcome everyone to the Kindle Report, where I share my 40 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. As we look back on last week, we saw the S&P grind up toward the all-time high at 3393. It failed a couple of times, but managed to hold key support, so the markets continue to be reasonably bullish as we come into this week. One of the things that I see happening here is market sentiment is starting to become a little bit negative up here. As usually a positive from a contrary viewpoint, as it's not likely that all the folks that are turning negative and telling everybody there's going to be a reversal this week is likely to happen. I will go through all the details shortly in the technical section to talk about what's going on with momentum and what the probabilities are for this week. The biggest thing that happened for me last week was the advance in the 10-year yields. We saw it print up to 0.72, backed off toward the 0.70 level by the close on Friday, but this is a significant event. We also saw the yield curve steepen substantially, and this goes in line with what I've been telling you folks on the channel for a number of weeks, that the Fed does not want negative yields. They want the 10-year and the 30-year yields to float higher, and their open market activities are going to continue to keep this type of bias to the 10 and 30-year yields advancing. Now, on Wednesday, we're going to get the FOMC meeting minutes. I don't see anything that's likely to come out of that that's going to be negative. We'll just have to wait and see what kind of details come out of that, as every word will be parsed out trying to place some sort of meaning about what they might be doing. But as we see these markets unfold, there's still a basic underlying momentum in them. The S&P closed up on the year 4.4%. NASDAQ is now up 22.8%. The Russell continues to lag as it's negative by 5.6%. I continue to expect to see this rotation and more leaning toward the small and mid-cap area as we go forward. So far, those trends have been muted, but they are continuing to bottom. One of the other things that continues to happen and keeps me positive in this market as our database continues to get more traction on an intermediate level. The short-term database continues to be very stable. I will go through all the details here just shortly. But as we look to the reports coming out this week, there's not a lot, but there's a fair amount of housing reports, as we have housing index on Monday, we have housing starts coming out on Friday, and the big report that everybody's watching outside of the FOMC meeting minutes this week will be the unemployment claims, as they're expected to be under 1 million for the second week in a row. I've been discussing this over the past several weeks, that the key number to watch is that continuing claims. It has dropped below 16 million and is moving toward 15 million. A number below 15 million on Thursday will be a very positive number, and I think market participants will key off of that. There's a couple other manufacturing numbers coming out, nothing really material. It's going to be up to market sentiment and expectations as we go forward. A quick comment on the stimulus package that just failed, and the government basically shut down when the rest of the country's in a crisis. Nobody's working, and these guys are taking time off because they can't stay and work and make a deal. It's so frustrating to see how this government is not functioning for the people right now. Can you imagine if you and I had a bunch of work to do and we just said, oh, we'll come back, we'll do it next month, don't worry, we'll get to it. It's just ridiculous to see how mismanaged the Senate and the House and both parties are acting right now. It's embarrassing. My expectations as we go through this week will continue to move toward an all-time new high in the S&P, and there's other factors that I think are going to be important to watch. Let's take a look at the charts and see what they're telling us for this week. Reviewing the WaveTech database, the short-term daily models continue to see a slight selling and liquidation of the database. It remains at 77.15% bullish. Between the two models, we saw 470 sell orders with approximately 200 buys, 200 and change of liquidation, very nominal. But as I've discussed on this short-term database, I do believe it's overdone. Otherwise, we'll start to see more selling on the short-term models. Now, many of the trades that have been on have been extended. And the interesting fact here is that when we look over on the right-hand side here, that the percent profit fulfilled is 87.8%. Now, normally that very seldom gets above the 78% level. It usually stalls out well before that. Because of this extended rally that we continue to see unfold, this is causing this metric to get to an extreme that we don't normally get to. So that is why I'm continuing to expect a rotation of some sort. It does not mean that it's a negative market scenario. It does suggest that there's the possibility of some grinding sideways in this market before we go into new highs. There's a lot of work to be done at these levels. And the fact is that once we broke through that 3280 level, we just spiked up to the 3380 level, is telling us we need to digest that last little rally before we move forward. The intermediate database has moved up to 67.46. I've been discussing this over the past several weeks, as my expectation is it will go approximately to 72 to 74% bullish, and then it will start some sort of rotation. But there's a lot of trades that have just come out in our intermediate models that are only in their first 20% of their holding period. If you look at the optimized weekly, you'll see right now that the duration fulfilled is 17%. And so there's still 80% of these trades in front of us, suggesting there's 160 to 180 market days ahead before this trend will start to rotate and start to see it fade. That suggests that there's likely to be an elongated trend that's going to go on into the first quarter of next year. Beginning with the S&P 500 futures, overnight we're seeing a slight positive of 10 handles, but after the close on Friday, there was a sell-off of about 6 handles. We're only a net 4 handles higher, so basically a flat opening is what we're looking at right now. As this week unfolds, one of the key things we're going to be watching is this PPM 1. Right now we're at 0.25. We are seeing a continuation of the sideways pattern. I've discussed this many times, but if you're new to the channel, the way that these indicators work is that momentum, it precedes the price action. So we saw big momentum back in March. All of these indicators will come into what I call a trend maintenance mode, and then they just waffle sideways. PPM1 needs to remain above 0.15. It's at 0.25 right now. PPM2 is at 0.23. PPM3 is actually accelerating, telling us that the underlying trend is still evolving on a longer term basis. This type of pattern can last a while. A lot of folks have been discussing the low momentum in this market and the volume. And from my viewpoint, that's very bullish because low momentum and low volume rallies can just grind out for a very long time, and they tend to go a lot further than you expect them to go. And looking at what's going on this week from a news standpoint, I don't see anything that's going to spike the volatility this week. Maybe the FOMC minutes, but it doesn't appear that news is going to drive it. Now, we do have about 250 earnings coming out yet this week, but that's going to wind it down. There are some interesting reports that are coming out, but for the most part, earnings is going to be in a rearview mirror. The market grid is contracting substantially, and this is somewhat dangerous. Right now, it's around 24.4 handles as the daily volatility range, but it's contracted substantially. If it continues to contract below 15, that could spell trouble for the markets. My expectation here is that we will continue to grind sideways. The PPM1 is more positive on the cash than it is in the futures. We're going to continue to see that pattern in that trend maintenance mode. I don't believe there'll be any major moves on the downside. As we look at the weekly market grid, S2 is 33.39. There's substantial support there, all the way down to 33.07 is the extreme for the week. I don't see us getting to that level, I expect to see the low for the week somewhere between 33.57 and the 33.39 level. From a weekly standpoint, the potential is for an R1, which is 33.88, which is a retest of last week's high, and then an S2 would be 33.39. However, if we did get above 33.88, of course, the key number is 33.93, which is the February all-time high. If we get above that, then you can see R2 and R3 could be in play at 34.05 to 34.23. Once again, going back to the reports, the earnings, and those type of things coming out, there doesn't appear to be a lot to trigger the markets to rally very sharply from here. I will be following these numbers very closely as we unfold this week. Looking at the weekly NASDAQ futures, the expected range, the extreme is going to be an R2 33.61. Doesn't look like there's enough momentum to get this to go through that level, but if we do trade through that level, the next levels to be challenged would be R3 at 11,841 and the RXT number at 11,589. Now we are seeing the PPM1 turn back up. All three of the PPMs, which are the price pressure momentum indicators, are very robust, telling us that the underlying trend is substantial and the probabilities for a major decline right now are minimal. This grid will dominate where the numbers are likely to go. I've discussed this over the past several weeks, that I believe that the NASDAQ remain in the range, and the most likely scenarios in R2, S2 this week, 10,906, 11,361. That's likely to be the range for this week. In the opening comments, I mentioned the 10-year treasuries. This is the weekly chart. We still have substantial downside pressure here. The key support now is going to be at the 0.63 level, closed at 0.71 on Friday. This configuration continues to suggest that we're going to see higher yields going forward. I'll take a look at the yield curve here in a minute, but the yields are definitely have an upward pressure on them. PPM2 has went through its first and second derivatives, which tells us that the 21-week moving average, which is at 0.65, this is the support zone between 0.65 and 0.63 is going to be major support. On the resistance on the upside, it's going to be 0.73 to 0.76. That's going to be major resistance. But this is a pattern that's unfolding here. Does indicate that higher yields are going to be the bias as far as the 10 and 30-year maturities go. Reviewing the yield curve moved sharply higher. This is the spread between the 10 and the 30. I expect this is going to continue to steepen, and this is likely to push all of the yields slightly higher. Primarily the 5, 10, and 30-year yields are going to have a bias to the upside, while we should see just a stability in the 2-year and the 13-week T-bills and so forth. Yield curve steepening will continue. It is actually a positive thing for the markets. It's going to indicate that the Fed is keeping that bias that I talked about in the opening comments, where they're going to keep the open market operations toward keeping the 10 and 30-year maturities floating higher. Next market we'll look at is the US dollar. This is the weekly chart. We're continuing to see a formation that is indicating that a bottom is forming. There's still about 2 to 4 weeks of work to be done down at these levels. It will be important that we hold the 92.50 level. A break below that would be negative and would suggest we'd see more acceleration to the downside. Right now, there's only about a 30% probability for that to occur. Likely to stay within the market grid this week and printing toward the 93.44 to 93.82 level, which would be R1, R2, and the S1 is 92.36, should be major support this week. And so expect this market to remain somewhat stable, slight bias to the upside as we go through the week. Next market is gold, and gold continues to remain in that range. Last week's close at 1949 was negative. We closed below the previous week's low. All the PPMs are starting to bleed off a lot of this upward momentum that we have. The key number to watch is going to be the 10-week moving average, and that is at 1868. Anything below 1900 is absolutely going to be a buy. We're up 0.41 right now. We're trading at 1957. Doesn't appear that that's in the cards for the moment. That level will be the best place to enter the markets. Down around 1909 to around 1890 is going to be will be your premium entry point. If you notice, the PPMs have all rolled over substantially. PPM 2 is about to break through its first derivative. Looks like the entire momentum of this market has just been crushed. It doesn't mean that we're going to enter into a downtrend, but it does suggest that a minimum of 4 weeks, possibly as long as 8 weeks, will in a sideways range, working this grid on this weekly level. As you can see, 1530 is R2, so S2, R2 would be the range to watch this week, which will be 1486 would be an extreme, and then R2 is 1530. Now, there will be substantial support down at that 1497 level. This market is likely to stay in this sideways configuration. On the daily chart, we're able to pick up some key support levels, and that's at the 1895 level. Just a minute ago, I mentioned the 1897 level on a weekly chart, so that's going to be substantial support if you get down there. 1964 is a 21-week moving average. If we can get above that, then you'll move toward the 10-week moving average and work the market grid on the weekly chart. So if you need to, just go back in the video and make sure you note those numbers. Those will be the numbers for the week to watch. The final market for tonight's video will be silver, and this is trading at a much higher volatility. I mentioned this the other day. We're seeing almost a 4% move overnight. Market grid on a daily, we did not quite make an S1. Right now we're trading 2735, which is a 2735, which is an R2 print, and there's also the 10-day moving average there at 27.10. That is still very positive. It appears to me that this market wants to get back above that level. The weekly grid numbers will be the best place to trade off of. I discussed this over the past several weeks. There's going to be a monster trading range in this market. You can look at the weekly market grid. RXT 3126, STX 20.91. From a grid standpoint, we're trading toward the R1 number, which is 2731. We've had a 2713 high. We look at the low side, 2591. So S1, 2486, S2. So it's possible with this volatility, you're going to see an S2, R2 number, 2350 on the downside should be the extreme this week, upside 2680. I've talked about this is going to be a tough market to trade, but if you can get really good positions, you're going to be able to scalp around these numbers pretty easily. We're not likely to see new highs in this pattern, but the extreme in the market grid suggests that there is a new high possibility. 3126 would be a slight new high. The momentum on silver is much stronger than it is in gold, so you can't make any correlations between what gold is going to do and silver. This thing has a lot of upside momentum. Could trade through the R2 number. R3 and RXT for this week would be an all-time new high. The highs 2 weeks ago was 29.91, so that does suggest there could be a new high. But right now it appears to me R2 2668, S2 extreme 2350. Expect to see continuing wild volatility in this market. This will complete the video tonight. Thank you for watching. We'll talk to you tomorrow night.